Greetings traders, this is Pti Trading Institution. I welcome you to this wonderful video. So today we'll be speaking about important aspect when it comes to forex trading. We'll be speaking about timing your entries. We'll be speaking about timing your entries because it is very important to get a perfect entry whenever you are taking your trade, whenever you are taking a position. The most important thing, it is an entry. So there are a lot of aspects that you need to consider when you are entering a trade. So I am just going to speak about three of them. I will speak about three of them. I will try to summarize everything so that this video can be short and it can be welcoming in your schedule. So let us get into it. So the first thing that you need to consider when you are taking your entries, it is the type of the wave, the type of a wave, because what you need to know is that in the market we have an impulsive wave and a corrective wave and also an impulsive wave. So basically the market move in these three steps. We only have an impulsive wave, which is the longest wave, and a corrective wave, which is the shortest wave, and the impulsive wave again. So the way you approach an impulsive wave is different to the way you'll approach a corrective wave, because an impulsive wave, it is the side where the strength is favoring, it is the side where the momentum is greater. For an example, in an uptrend, the impulsive wave, it is the waves that are going up, yet in a downtrend, the impulsive waves, it is the waves that are going down. So the first thing that you need to understand, it is what type of a wave is the market in. What type of a wave is the market in? So let us just make it clear. So basically when you find, let's say you find the market moving in an uptrend like this, you find the market moving in an uptrend like this, and you find it right in this level here. So what you need to know, the way you will enter the market in this level and the way you'll enter the market in this level, it is very different. In this level, it is less risky. It is less risky to enter the market in this level, and in this level there is more risk. So basically the way you will approach the market, it will be obviously different. So for an example, here it is guaranteed, or 60% of the chances are the market is going to go up because the market has been going in an uptrend. But when we come to this level here, we are not sure whether this impulsive waves has come to an end or it is still going to continue to go up. So what you need to know is that you need to first consider the type of the wave. So when you are looking for maybe an impulsive wave like this one, you need to know that you will be counter trend trading. You'll be counter trend trading. So basically you'll be trading against the trend. You'll be trading against the trend. So what you need to know is that you then need to consider how much stretch the wave is. For an example, let's say you want to enter in this position here, you need to consider the size of your impulsive wave. That is, this wave also equal or greater than these other previous waves which we see in the previous price here. So that's what you need to consider. So you can't just enter at this impulsive wave when it is less than or 50% of the previous one, which means that the price is not yet overstretched, so it is hard for it to go down. So it is more risky for you to take that position. I hope it is making sense. So let me just remove and make it clear. Okay. now let's say then the price, you find the price on the corrective wave. So basically what you are looking for in the corrective wave, you are looking for signs of your sellers losing momentum, because now the corrective wave are the wave of the sellers. So what you're basically looking at, you are looking at sellers showing signs of struggle, showing signs of facing a challenge when it comes to them pushing the price down. For an example, let's say your price was going down, as I always make an example of candles. Let's say these are candles and your price has been going down, and now as you can see that now your candles are decreasing in size, which means as you go down, your sellers are losing momentum, they are losing the strength. So basically if you see such a pattern in your corrective wave, you need to be ready to take the price up. You need to be ready to enter your position. So I'm going to clarify how to see when to enter and when not to enter. So you need to understand if the price is in a corrective wave or the price is in an impulsive wave. So if the price is in an impulsive wave, you need to know that you will be counter trend trading, and your target will not be bigger than it will be when you enter from a corrective wave. When you enter from a corrective wave, you can target as high as you want, but when you enter from an impulsive wave, your target will not be great because you are not sure at that time if the trend is reversing. You see, so when you enter from an impulsive wave, you need to make sure that now I am sure that the market is taking the other direction. So it is very dangerous to enter from the impulsive wave. It is advised to enter from the corrective wave. When the price is correcting, then look for an entry. So the other thing that you need to consider when you are looking for entries, it is the price pattern. It is the price pattern where in the corrective wave, the price pattern in the corrective wave, where is this, the price pattern in this corrective wave, because you are looking forward to take the price from the sellers. You are looking forward to buy from the sellers. Why are we not buying in the impulsive wave? Because we cannot buy from buyers. So when everyone is buying, we can't buy. So we need to buy when people are now selling, or when the market is now selling. So basically when the market is going down, that's where we are looking to buy and take the market up. So what you'll be looking at, you'll be looking for price pattern in the corrective wave. Price pattern in the corrective wave. So there are a lot of patterns that are very important. For an example, you can be looking for flags, you can be looking for wedges, you can be looking for triangles, you can be looking for rectangles. Those are patterns. Most of them or all of them are they end with a breakout. So basically you'll be looking for a breakout, maybe from a flag, a breakout maybe from a wedge. For an example, I'll make an example with the flag. Let's say the price was going up and now it is correcting, so and then it pushes up again. So basically it has formed a flag. So where will you enter your trades? You'll enter your trades basically when your flag is broken. So you, in your corrective waves, you'll be looking for such patterns in your corrective wave, and then you'll be taking breakouts. So even when it comes to wages, price will go up and it will begin to form a wedge. It will begin to form a wedge and it will break out. So basically you'll be looking for a breakout in this level. Remember, this is your corrective wave. This is your corrective wave. So basically that what you'll be looking at when you want to get perfect entries. You are basically going to be entering from the breakout of the pattern that is inside the corrective wave. So the last thing that I can mention for now, it is a candlestick pattern. Looking for a candlestick pattern in your corrective wave. Remember, that's where we enter from a corrective wave. We take the price from sellers. If you want to buy, we take it from sellers. If you want to sell, we take it from buyers. So you'll be looking for candlestick patterns. For an example, let me make an example of this flag. Where are you going to be looking for a candlestick pattern? You are basically going to be looking for a candlestick pattern here. So let's say there is a doji like this in this level. So basically when the price breakouts here, this candle, it confirms that you can enter your breakout, because we see that the breakout was initiated by a doji or an exhaustion candle, which shows that now your sellers are weak or your sellers are losing strength and your buyers are coming in. So if you are not maybe looking for patterns, but let's say even your doji is formed in this position here, you are also going to be pushed by it, by seeing it that now there is an exhaustion candle, now there is a reversal candle. Let me press my buy button. So basically that's how you can time your entries, by looking at the wave. Is it an impulsive or a corrective wave? Looking at the price pattern and also looking at a candlestick pattern. Is there any exhaustion candle? Is there any candle that is telling you that okay, now your sellers are weak, now your buyers are strong? So if there is such thing, then it is very good for you to enter that position. Even if it goes against you, at least it will go against you while you have respected all the principles that are needed for a good entry. So thank you for watching. This is Pti Trading Institution. Remember to subscribe, like and share this video. Thank you.